Hello, this is Paul Harris from Mining Journal. I'm joined today by Peter Grosskopf, CEO of Sprott Inc. Good morning, Peter.
Good morning, Paul.
Sprott is about to do a dual listing in New York. Maybe we can start talking a little bit about what the thinking behind that is. You're already listed on the TSX, so what's the thought behind listing in the US?
Well, we're largely a US-based company now. Our client base is certainly heavily skewed towards the US. Our funds are mostly quoted in US dollars, and the gold business itself is quoted in US dollars for the large part. And having a Canadian listing only and having a Canadian dollar stock price only was adding some volatility and some complexity to having the shares accessed by US investors. Most people who know us know that we have a tremendous retail following, a lot of retail clients in the US. And believe it or not, in this modern age, a lot of them are still prevented from buying a Canadian stock, not because of its size or legitimacy, but because their back offices and compliance departments still have impediments against foreign stocks. So for us, it was a way to put our client base together with our shareholder base, and we think there's a lot of upside from that.
Okay, the Sprott group of companies are famous for being sort of very prominent investors in the precious metal space. And you have various different products. You mentioned the physical gold fund, but you've got the Sprott lending, and you've also take equity positions in junior companies. How did that sort of portfolio come about, and why is it necessary for you to have those different product lines?
Well, I guess it was more a function of history than anything else. We had started our background as a public stock manager in 1981, and we had been running portfolios for private clients, which we then converted to mutual funds and hedge funds in the year 2000. So we came at it from the background of being a stock picking firm. The bullion trusts and the lending fund and the private equity style funds that we've added in the business have all been a function of just getting broader within the sector. And those cater to very specific investor bases and investor interests. And it's really just a function of coming at the sector from almost every viable perspective and having funds that cater to investors that appreciate that particular strategy. So we have the bullion funds, we have the public equity funds, we have equity indices, which are ETFs, we have private funds ranging from equity private funds to debt private funds.
Okay, on the stock picking aspect, that's obviously continues to be a key element of the Sprott portfolio, and you've become over the years perhaps the go-to name for junior miners, junior explorers seeking investment. Your competition's got less and less, really. What advantages does that give you, or what risks does that present for you as well?
Well, I think you're right. We were kind of the last man standing in the sector when it was going through a bear phase, and when sector funds were very unpopular. There were a lot of larger asset management businesses that dropped their gold funds. The advantage that gave us was it allowed us to either buy some of our competitors out or attract talent into the firm. And I think that was the big advantage of being the last one who was really dedicated to building a larger firm in the sector. The risks, the impediments might be, well, some people do say that Sprott is hard to understand. It's hard to handle a firm that has that many different strategies all within the same sector. So sometimes we get clients that don't know what they want. They just want a precious metal investment in general. So we have to steer them to the right product. Takes a little bit of extra work on our part. And then for some of the companies, the issuers, they might be confused as to what side of Sprott to talk to. But generally, we can handle those things, and we think the advantages outweigh the disadvantages.
Okay, you've over the years you've hired some very well-known names and some experts in the different businesses. Is there a competition for capital allocation, or how do you manage things like that?
Well, right now we're fortunate enough to probably have more capital being offered to us than opportunities in a lot of the funds. I would say that there's always the main objective of every portfolio manager that works for Sprott is to find a great investment opportunity. So is there competition for investment opportunities? We tend to keep that to a minimum. Each fund has a specific profile. So Neil Adgehead, for instance, manages early stage investments in the sector. We don't have other funds doing that. Likewise, John Hathaway and Whitney George and their equity team manage kind of mostly mid-cap style positions. And again, we don't have a lot of competition. That internally, that team acts all as one. And same thing for the debt business, which is quite different, as you know.
Okay, in recent weeks, barely a day has gone by without a junior company announcing some kind of investment, some equity investment by Sprott. Investing in juniors is obviously very high risk. So how do you seek to manage that risk or the risk that they bring?
Well, every team on our investment side does a lot of due diligence. And so it might look as though we're throwing darts because we're making a lot of investments, but in fact, that's what's required to sort out the right opportunities and to plant the seeds that we need for to test out a property to see if it's worth a bigger capitalization and a bigger investment. Every team does due diligence. Every opportunity is looked at for risk and reward. Many times those are technical decisions. Does the geology warrant more? Is it exciting? Is the risk reward good? So we have calculated strategies for making that number of bets, and we're looking for obviously very high returns and alpha compared to the risk that we're taking.
Okay, you obviously see a lot of juniors in any given week. What are the things that you really want to see in a junior? What are the things you would like to see? And what are the sort of the common sort of red flags or mistakes that companies make when they come to you?
Sure. Well, if it's a drilling play, if they're developing a resource, we like to see the potential for the resource and reserve to be of a certain size and quality. We're not really interested in scrappy small deposits because we find that the hurdles for mining these days are so high. It takes so long. There's so much social investment that's required in each project. So we like to see a resource that we know can handle a kind of a world scale operation, which for us is 100,000 ounces plus a year. I guess in terms of an existing producer, we're looking for something that's undervalued, that has a catalyst for growth, that's not really appreciated by the market, where there's something that may need to be fixed or proven out. And the potential then is for them to do much better than the index. I would say that's kind of what we're looking for. What we're not looking for is, the first thing we probably look at is management. Are management credible? Do they have the right people in the right positions? Are they overly promotional or are they accurate? Do they have a sensible plan? And are they aligned with us as investors? Do they have substantial personal stakes in the business, or are they kind of corporate managers that are just promoting and taking a salary? So that's the most important thing. What we also look to avoid is certain groups in the business that have a bad reputation for being over promotional. Other than that, it's probably down to the fundamentals. What's the deposit like? And we don't like very small deposits that are going to need a lot of capital and not going to make the grade. So we try and filter those out. And I hate to say it, but it's a process where it's 1 in 100. We're actually looking at hundreds of opportunities, and you see a lot of investments, but it's a pretty small ratio.
Yeah. How do you determine the exit strategy of a particular investment? Obviously, you're making an analysis. You think, this project potentially has the scale potential you're after, or the other characteristics you mentioned. But what point, for example, would you look to sort of, okay, the investment's achieved what it set out to, it's time to cash that in, or to move on to something else?
Well, we do need to think about liquidity very carefully, because a lot of these are smaller capitalization stocks. So generally speaking, we're looking for a catalyst. We have a game plan. We're looking to exit when certain valuation metrics are achieved. And we have to start thinking about that exit well in advance, because we are a long-term investor. We don't like to be disruptive with our trading. We're not a sharp penciled hedge fund that is, willing to be super aggressive. We're hoping to try and build companies. So with that, there's the discipline of saying, okay, if they've reached a certain level, it's time for us to start letting go a bit. Most of our positions are, I think on exit, they're taken out by somebody else. So they're bought by a larger company or by a larger group of investors as they get to be bigger cap.
Okay, thank you. Sprott lending has become more of a force over recent years, and it seems to have been grown into a much more important element of your business. But obviously, in that space, you're competing with more traditional lending sources. You perhaps have much more competition there than in other aspects of the business. So, why did the company decided to really push into the lending business, and what particular advantages do you think you have there?
Well, we got into the lending business post the financial crisis, and there was really quite a hole there. I mean, the banks had basically wound down their books and their exposures, and the bond markets were largely shut for mining companies. So we were one of the 4 or 5 global specialists that really put a tangible effort on the table to build a lending practice. And all of us in that club have been successful with our lending business. I think the reason why we're particularly successful is we see a broad cross-section of opportunities. We understand what management teams want, which is to take their deposits and their projects to the next level. We're easy to work with. We're quick. We're not bureaucratic in terms of making decisions. We understand mining companies, and there's always some amendment that's needed to the facility. You always need to grow with the company. So it gives us a real long-term tangible benefit and advantage to being in that sector. Yes, there's competition. There's always someone who's willing to come in with a cheaper cost of capital, or a bank that can lend more money. But management teams, they want to fit more than anything else when they're talking to a lender. That's how we're successful. Yeah.
Sprott obviously understands natural resources. Okay, so final question, Peter. After listing in New York, what's next for Sprotts? How would you like to see the business continue to develop?
Well, we see ourselves as almost a royalty company, like profit earner in the sector. We pay a strong dividend. We have good margins. Obviously, growth comes through performance. It comes through inflows. But we really see the gold sector is still having tremendous opportunity. It is a $2 trillion investment sector. People do not realize how big it is. So, and it's under-owned by most investors. So the adoption curve of having gold become mainstream portfolio holding and insurance is still in its early days. So we just see ourselves being a lot bigger, doing what we're doing, a lot more profitable, and I guess potentially offering funds in more global jurisdictions as well.
Okay, thank you. Well, thank you, Peter. It's been a pleasure speaking with you today. Congratulations on the New York listing. I hope that all goes well for you.
Okay, thank you. Thanks for your interest.